I'm Jerry Pierce, coordinator for the Kentucky Farm Business Management Program. KFBM is an extension program administered through the Department of Agricultural Economics. It includes 8 farm management specialists who work with over 400 farms in the program. In this segment, we'll look at the impact of these projections on crop farms using the crop farms participating in KFBM. Unless otherwise noted, all the data represent the average commercial crop farm and are from the farms participating in the program. Net farm income reached $331,000 last year. I'm projecting a 14% increase to about $378,000 this year. That projection is based on 3 things: the report of exceptionally good yields, surges in commodity prices at the end of harvest, and large amounts of government support. Cash prices have pushed $4.25 a bushel for corn and over $11 for soybeans. Compare that to last year's $4 average price received for corn and $9 average price received for soybeans. The average farmer received $187,000 in government payments last year. I'm projecting a $226,000 average payment from ARC, CRP, CFAP, PPP, EIDL, WIP, and others. That creates a matter of concern for 2021. Look at the FSA payments available to Kentucky crop farms, not counting SBA loans or NRCS or other government payments. FSA paid out $251 million in MFP last year and $355 million in CFAP this year. Note the widening gap between net farm income and net farm income from farming activities. That's a difference last year of nearly $186,000 in government payments. 56% of net farm income last year was from government payments, and it's projected to be 60% of net farm income for this year. The concern is it's unclear whether farmers will receive any program payments, government payments support in 2021, and net farm income will drop accordingly. Now, what's the impact of net farm income on financial condition? A well-known financial advisor said, it's not how much money you make, it's how much money you keep. So what are the uses of net farm income? On the farm, family living, debt repayment, investment in land and equipment, and what they keep available for the opportunities and challenges that will come. Family living generally follows net farm income and the economy. For the impacts of the other uses of net farm income, we have to look into the balance sheets. In the long term, we look at solvency. Is the value of assets sufficient to cover all debts? It's measured by the debt to asset ratio, and it becomes a concern between 30 and 70%. You're seeing here a 29% debt to asset ratio, and it's been that way since 2014. Largely based on steady farmland values. For the short term, we look at liquidity, the ability to pay the principal due in the next 12 months. We measure that in working capital, the amount of cash, crop, prepaid expenses, and accounts receivable that exceed the principal payments due in the next 12 months. It's highly dependent on net farm income. Note that working capital reached over $1 million in 2013. It was eroded away, and we've nearly recovered by the end of 2019, putting crop farms in a very good position this year. A more precise way of looking at liquidity would be the working capital ratio. It compares the dollars of working capital to the dollars of principal payments due in the next 12 months. Economists would like to see a 2-to-1 ratio. We were there briefly, and we're closing in again on it at the end of 2019. The projections on net farm income suggest that we have an opportunity to prepare for the uncertainty of 2021 by building cash reserves. That'll result in working capital ratio. I'm encouraging farmers to sell crops, postpone equipment purchases, even pay taxes. Build cash reserves. Note too the changes in the amount of the types of liabilities. Long-term debt exceeded current debt, mostly from refinancing prior year's operating notes on longer terms. Intermediate debt for machinery and equipment declined during the middle of the decade, but crept back up to the peak that we saw in 2013. By definition, half of all farms are below average. Farms in the low third experienced negative net farm income losses in 4 of the last 6 years, even with MFP, and merely broke even the other 2 years. This created some difficulty, challenges for these farms to cover these areas of family living, debt repayment, investment in land and equipment, and having something available for the opportunities and the challenges that do come. Solvency for long-term debt is still manageable, with a debt-to-asset ratio of about 40%, again due to stable farmland values. But the drop in net farm income has resulted in significant deficiency in working capital, including negative working capital in 2015 and 16. That created some difficulties meeting payments and required some adjustments for those farms. Note that even with increased net farm income in the last 3 years, working capital has deteriorated again by the end of 2019. We find that many lenders require minimum working capital ratios, something around 1.3 to 1 or something like that. These farms often find it difficult to obtain operating loans, limiting their options and making it difficult to continue farming. I'm hopeful that the projections here for increases in net farm income and the availability of government support this year will help these farms in their recovery. And I hope that these projections provide a ray of sunshine for all the farms in face of the uncertainty of the coming year.